Let's be real, everyone wants to get rich in the stock market, right? We all see it as this incredible path to building wealth. But, if it were that easy, we'd all be millionaires by now. The legendary investor Warren Buffett has some really powerful wisdom on this, and it's the perfect place for us to start.
So what does Buffett actually mean by this? Well, the core ideas, buy low, sell high, pick good companies, they sound simple enough on paper. But the hard part, the not easy part, is keeping your cool when your emotions are screaming at you and the market is on a total roller coaster. That right there, that's the moment most people make their biggest, most costly mistakes.
And check this out. Here's a number that really drives that point home. A 2023 report found that a staggering 80% of overconfident retail traders, we're talking 8 out of every 10 people, failed to beat the market in the long run. Just think about that for a second. They don't even match the average. It just goes to show you overconfidence can be an incredibly expensive mistake. So, how do we make sure we're not one of them? Here's our game plan. We're going to start with the psychological traps our own mind set for us. Then, we'll dive into common strategic blunders. After that, we'll expose the unseen enemies that quietly eat away at your returns. And we'll finish up with the single biggest lesson every single investor needs to learn. Okay, first up, psychological traps. Look, before we even glance at a stock chart, we have to look in the mirror. This is all about the battle that happens right between your ears. Seriously, mastering your own emotions is the absolute first step to mastering the market.
So the first trap is overconfidence. You know the feeling. You get a few wins under your belt, and suddenly you think you're invincible, that you can't lose. Next up is the herd mentality. You see everyone online rushing to buy some hot new stock, so you jump in too, often without a clue what you're actually buying. And finally, the biggest one of all, letting fear and greed call the shots, which causes you to do the exact opposite of what you should, sell at the bottom and buy at the very top. And this slide really breaks it down, showing the two mindsets side by side. On one side, you've got herd mentality, which is all about reacting to hype. It's that little voice in your head saying, hey, everyone's buying it. On the other side, you've got independent thinking, which is proactive and driven by cold, hard data. That's the voice that says, I'm buying this because my research backs it up.
So how do you fight that urge to follow the crowd? Well, Buffett gives us the perfect antidote right here. This quote is legendary for a reason. It means that when everyone is getting euphoric and piling into the market like it's a party, that's your cue to be cautious. And when everyone is panicking, selling everything they own, that's when the real opportunities show up for people who've actually done their homework.
And this quote? This one gets right to the heart of emotional investing. Panic selling when the market dips? That's pure impatience. Greedily FOMOing into a stock at the peak of a bubble? Yep, that's impatience too. In both cases, your impatience is literally handing your money over to investors who know how to wait. In the stock market, patience isn't just a virtue, it's profit. Okay, so if having a patient mindset is the foundation, what comes next? Well, that brings us right to section 2, strategic blunders. This is where we shift gears from mastering our own psychology to the mistakes people make in their actual planning, their research, and how they execute their trades. And here's some of the biggest culprits. First, just completely ignoring proper research, maybe buying a stock based on a friend's tip or something you saw in a headline. Second, trying to time the market. Thinking you can perfectly predict the highs and lows. Third, just jumping in without any clear plan or goal for your money. And here's a surprising one. Over-diversifying, where you end up owning so many different stocks you can't possibly keep track of what's going on. And doing your research isn't just some vague suggestion, it has a direct impact on your bottom line. A 2024 study found that investors who actually do their homework earn, on average, 20 to 30% more than those who don't. That is a massive performance gap that comes from simply understanding what you own.
And for anyone out there tempted to try and outsmart the market, Buffett's advice here is absolutely crucial. Study after study shows that investors who try to time the market by jumping in and out actually end up with way lower returns, sometimes as much as 40% less than people who just stay invested. It's pretty much impossible to predict short-term moves, so it's a lot more effective to just focus on the long haul.
So, if market timing is such a bad idea, what's a better way to do it? Simple. Consistent investing. Just look at this example. Instead of trying to guess the absolute bottom, you invest a fixed amount on a regular basis. Say the market's at 100, you put in 200. It drops to 90, you put in another 200. It drops again to 85, you put in another 200. See what happens? You end up buying more shares when they're cheap, which brings your average cost down. It's a simple, powerful, and totally unemotional strategy.
And this quote really gets to the core of why you absolutely need a plan. Why are you investing in the first place? Is it for retirement in 30 years? A down payment on a house in 5 years? Your goal completely changes your strategy. Without that goal, you're just kind of throwing money at the market and hoping for the best. And like the saying goes, a goal without a plan is just a wish.
All right, so you've worked on your psychology and you've built a solid strategy. You're safe now, right? Not quite. That brings us to our third section, unseen enemies. These are the sneaky, subtle forces that can silently sabotage your portfolio, even when you think you're doing everything right. So here are the hidden threats. First, ignoring the absolutely incredible power of compounding, especially when you're young. Next, forgetting about all the little fees and charges that add up to huge amounts over time. Also, not reviewing your investments regularly. That whole set it and forget it thing can be really dangerous. And a very modern problem, chasing those hot tips you see flying around on social media.
Let's just talk about compounding for a second because I think a lot of people really underestimate it. Let me ask you a question. If you start investing just 5,000 rupees a month, starting at age 25, what do you think that could grow into by the time you're 60? Go on, take a guess.
The answer is a staggering 4 crore rupees. Nope, that is not a typo. That is the incredible, mind-bending power of compounding at work. Your earnings start earning their own money, and it just creates this massive snowball effect over the decades. It is the most powerful force in finance, and it's available to literally everyone.
Now for another silent killer. Fees. You know, brokerage charges, transaction taxes, they all seem so tiny and insignificant. But over a lifetime of investing, these tiny leaks can absolutely sink a big ship. We are talking about lakhs of rupees just silently being drained from your portfolio, money that should have been compounding for you, not for someone else.
And this brings us to our final section, the one that really ties everything together, the biggest lesson. This is about the one mistake that is more damaging than all the others combined.
And here it is, the ultimate mistake, not learning from your mistakes. Look, everyone, and I mean everyone, even the greatest investors in the world, makes errors. It's just part of the game. The real failure isn't making a mistake. It's repeating it over and over because you failed to learn the lesson the first time.
So how do you actually learn from them effectively? It's a simple 3-step process. First, you have to acknowledge it. No excuses, just own it. Second, physically write it down in an investment diary or a journal. The act of writing makes it real and concrete. And third, make a conscious vow to yourself not to repeat that specific error. This is how you turn a loss into a valuable and permanent piece of tuition.
And that's our look at the most common investing mistakes. We've covered the psychology, the strategy, and all those hidden dangers. So I'll just leave you with one final question to think about. After everything we've talked about today, which single mistake will you commit to correcting first?